Hello traders, so in this lesson we're going to talk about extreme fair value gaps and how to use them for your directional bias and your entry. So let's talk about what is an extreme. So you have your premium and your discount zone. So obviously it would be cheaper to buy price when it's in your discounted zone, and it would be more profitable to sell price when it's in your premium. So what would be your extreme? Your extreme would be the top portion of each one of these sections. So this would be the extreme of your premium zone, where you're more than likely to sell price. And this would be the extreme of your discounted zone where, so let's go on to the next step. What is your range and how is the range formed? So as you can see here, you have your swing high and you can see price breaking your swing high. So when price comes back inside of that swing high that was previously broken, now you have your range, which would be this swing high and this swing low. Simple. This is your current operating range. So now how do we combine your range and your extreme zones? So as you can see here, you have your swing high and your swing high is broken. And now that price came back inside the range, we have our range set. So now the top half is your premium and the bottom half is your discount. So now how do you get your extreme zones? What you do is you break both of these sections into half. So now the top quarter would be your extreme premium and the bottom quarter would be your extreme discount. Before you proceed, please make sure you like the video and leave a comment. This video is completely unmonetized to make sure you guys are not interrupted by ads. So based on everything you learned so far, what are we looking for? As you can see, first thing you want to do is you want to mark out your range. So here you have your swing high and here you have your swing low. And why is this our range? Because as you can see, what happened here was that price broke this structure, wicked below, and came back inside of the range to start new micro structure. So what does that tell us? That tells us that this is our range. This is our current range. Now what you do is you pull out your fib, go to the highest point. So now this would be your extreme. And this would be your extreme. So these are your both extremes. This would be your premium extreme and this would be your discount extreme. And here are the settings for your fib. It's 0, 25, 5, 75, 1. So what are we looking for? We're looking for a fair value gap in our premium and discount zone. So for right now, we don't have anything in our extreme discount, but we do have a fair value gap in our premium. So these are the fair value gaps we'll be targeting. So how would we trade this? So as you can see here, you have your fair value gap right here. And in this case, this is obviously a bullish fair value gap. So what you would want is you would want price to complete this fair value gap, completely close it and give us a signal candle, which in this case, since it's a bullish fair value gap, we would want to see a bullish candle. This would be our confirmation that this is a valid fair value gap, extreme fair value gap. So like I mentioned, what we're looking for is a completion. So as you can see here, price completed your fair value gap and gave you a red candle signal. Now, if this fair value gap was not completed, if it was, let's say, if the fair value gap reached right here and then reversed, this would not count. We want a completion and at the same time we want a red candle, preferably an engulf. Now if we don't have an engulf candle, price is not completely engulfed, you can wait for an engulf or you can just take the first signal, which is just a red candle. Preferably you would want an engulf. So in this case, if you want a high probability trade, you would wait for another red candle to close right here and you could always take the retracement back inside that micro range. So we are making the Discord server. If you're interested, make sure you join the free Telegram for updates. Let's take a look at this example. So why did we pick our 8-hour time frame? Because this is where we can spot price action clearly. As you can see, this is the highest we can go. Start off from the daily, we can barely see price action. 12-hour, we can barely see price action. This 8-hour is the highest we can go. And if you want more details, make sure you watch my previous video on timeframes and make sure you check the website. So you can pull out your fib and you can look for the obvious fair value gap in your extreme. And obviously you're going along with the trend. So you're looking for a bearish fair value gap. And here we have a bearish fair value gap in our extreme zone. So on the same time frame that you're operating on, as far as your macro goes, what you're waiting for is a signal. First, you want a completion. So let's say price reverses right now and gives us a red candle right here. This fair value gap would be insignificant. Why? Because it did not complete our fair value gap. So now let's say price completes your fair value gap and gives you a red candle. Now you can enter the trade based off your signal. And you could take it right back to extreme. This would be a mid-quality setup. What you would want is a complete engulf. You would want a complete engulf of a candle. Now, if you had a candle like this, completely engulfing, yes, your stop loss would be bigger, but at the same time, your probability would be higher. So you're sacrificing your R&R for probability, and that's how the game goes. So if you were waiting for a high probability signal, your entry would be right here. And your stop loss would be right here, and your TP would be right here. So you're looking at a 1-to-1 if you're looking for the highest probability setup. Now, if you're just waiting for the first signal, you could have already been in and you would have had at least a 2R in. So another thing to keep in mind is if you're looking for a lower time frame entry, you can always go and look for where you can see structure, which in this case, you're looking for a microstructure. You can probably go to the 30-minute. Yep, this is where you can see clear structure because as you can see here, price was giving you higher lows and higher highs right here and gave you a swing right here and was giving you clear swings right here. So what you would wait for obviously is your shelf. You would wait for a shelf to happen, and once that shelf occurred, you can take a trade below the shelf as an extra confirmation on your lower time frames. So once price broke out of this level, you would be taking this entry. Let's carry on. Go back to our macro. So now you have your breakup structure. And if you didn't have your breakup structure, it could always be an internal to an internal trap. So what you're really looking for is a swing. So now let's see if price comes back inside the range to confirm the supply and demand structure. Now price came back inside the range. So do we have a fair value gap in the extreme? What I can locate here is a clear fair value gap right here that's already been tapped. If you can see right here, this fair value is already been tapped by this candle. And even if it didn't get tapped, this fair value gap is not an extreme fair value gap. So we're not paying attention to that. This is more of a fair price fair value gap. And as you can see, you do have an extreme fair value gap right here, but it's already been tapped. So we're not paying attention to any of this. We want clean fair value gaps. So let's carry on. Even though it worked, a lot of times the probability would not be in your favor. The fact that this fair value gap has already been tapped. We're looking for fresh fair value gaps. And now you have your internal to an internal swing. So price rejected from an internal level, price rejected from an internal level right here, and rejected from an internal right here, forming your range. So now you have a swing high here and you have a swing low right here. So where would your fair value gap, extreme fair value gap be in this range? It would be right here, taking price back to the bearish side. Now, where would your fair value gap be on the bullish side? Their fair value gap would be right here. And why are we marking both sides of the fair value gap? Knowing that when you do have an internal into an internal trap, like I demonstrated previously, price could go either way. Obviously, you would want to go in with your macro trend. So as you can see, the trend is bearish. Price has been making lower highs and lower lows, and lower highs and lower lows. So you would prefer to take your bearish extreme fair value gap in return to your bullish, because here you would be going against the trend. So what happened here? Price completed. Now, another thing to keep in mind here is that you don't want your fair value gap to, even if it wicks out, you don't want it to wick out above your structure or even above the initiation of your fair value gap. That would negate the trade. You'd want to keep it right below. And as you can see here, you can look at multiple examples from a previous structure. Let's find an example as far as that goes. There is really no example as far as that goes here, but we'll continue. So what are we waiting for? We're waiting for a signal. And here you have a clear signal. And why is this a clear signal? Because you have an engulf. So this is a high probability trade. So you could get in the trade right here and take it right back to this level of danger, because price could pop off from this area. And your stop loss is right here. Now on the micro, like we said earlier, we're operating on a 30-minute. You would be waiting for a shelf. So your shelf would be your first swing high, swing low, micro range. So after closing the fair value gap, so here you would take a trade right below this level, and your stop loss would be a lot smaller. Let's go back on the macro. And this is what I mean by you don't want your, you wouldn't want to take any bullish fair value gap, even if the trend was in your favor. The fact that as price closed this level, price took out the low. Once price takes out the low, you're disregarding this fair value gap. And you don't even have to go as far as the low. You could just say once price closes the initiation of that fair value gap. So it doesn't even have to be the exact low right here. It could be this candle right here. Once price takes that out, you really want no parts as far as that fair value gap goes. And same with right here. If price would have took this level out right here, even with a wick, you would disregard this fair value gap. So take a look at this. You had a fair value gap right here in an internal to an internal range. But what happened here? Price took this swing out, this swing that initiated the fair value gap. As you can see, this swing is a part of our fair value gap. So once that happened, you are disregarding this trade. So even though you did have a completion and you did have a signal, you are not taking this trade. Absolutely not. One, your stop loss would be ridiculous. That's the first indication. And even if you do have a moderate stop loss right above your fair value gap and you're trying to take price back to an extreme level right here, just the fact that price took out this level, we're no longer working with this fair value gap. And as you can see, you will lose the trade. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you leave a comment.